7:45 this Tuesday morning as we get to your money. Got a lot of questions this week about SpaceX. Of course, after its record-breaking IPO last week, those shares are high. They continue to get high. So with that, you've got questions about its future. Does that reflect the company's actual performance, or is this hype? Got certified financial planner Derek Williams in with us this morning to talk all about this and what you need to know. Good morning to you, good sir. That's not foreign whenever you've got a high-profile debut on the stock on the exchange, shares being high, and whether it is hype or performance. With SpaceX, what are you seeing?
What I'm seeing is an overvaluation. Right now, if we were to put SpaceX in the S&P 500, it would be the sixth largest company by market cap. So last night with some of the late night trading, it's actually bigger than Amazon and Microsoft, which so that's really hard for me to believe. But in terms of revenue, it's a 200 biggest company if it were to be in the S&P 500. So I'm a little cognizant right now and waiting to see, how the revenue, gets, reported, over time. Because of course, with being public, now you're going to see more of the numbers, with Q2 coming up, as well as, Q3 and Q4.
Right, that point about perception versus reality, you got to watch what you see and what you read and what you hear.
Yeah,
but
absolutely.
You're seeing in the coverage of this, you're hearing from Elon Musk himself talking about revenue, projecting it to reach the $1 trillion mark by 2031. So if I see that and it's being reported directly, I would believe from the source here, he's the person who owns the company, what's my takeaway? Is he doing that to get me to buy shares, or is that true?
I think long term, it is a great play, seeing Elon and what he's done in the last, 10 to 15 years with Tesla and other companies, it's hard to bet against them. So I think, if you're an investor and you're, have the ability to maybe put some money in SpaceX and hold it for a couple of years, I think it, could definitely be a great play. Where I'm kind of cognizant right now of people trying to, buy in this first couple, weeks of the, initial public offering, and then, try to maybe make a, quick dollar in the first 3 to 6 months, because I think you see a lot of volatility. I just saw it on the screen of, there was a great chart last week put out by Truist Wealth about the last, 15 years, 30 of the biggest companies that went public. And there's so much volatility, in that first year. And, the first 3 to 6 months, companies are doing well because, a lot of these insiders aren't able to sell their shares. So I think as you get into that, 3 to 6 month mark, SpaceX employees are going to be able to sell their shares. So that's going to be one of the big things I'm watching, is to see how the stock, kind of reacts as some of these employees and insiders, sell their shares.
Right, and I think that, we were up just a little early with that graphic there showing those numbers that you were talking about. But they speak to what you're saying here, and that is, over time, the value that you're putting in, whether it's worth it. And we're seeing more often than not with a lot of high-profile debuts, you lose your money, and that's what we're looking at here.
Yeah, you certainly could. I mean, the first 3 to 6 months, a lot of those, IPOs, were positive, but the more you go, into time, less of those companies, are as, valuable as they were in those first 3 to 6 months of the offering. And I think only about, 43% of those actually return a, net positive gain in that first year. Certainly there's companies who did really well in their first year, but again, that's back to what one of my points is, being careful of, trying to ride this high in these, first 3 to 6 months.
Well, it is hot now. Do I buy shares?
I think there's certainly a case to be made to buy shares, but I would just be cognizant of, not putting, too much of your, money into one basket. So, I'm certainly, telling, my clients, if you want to buy, a couple $100 or a couple thousand of shares and it, doesn't, change your 401k too much, certainly can ride that. But if you're someone, who's going to retire in, the next 2 years and you're going to put, over half your 401k, definitely don't do that, which I've seen, an argument to, maybe put, 20 to 30% of, someone's IRA in it, and that's, just a little bit too high. So being cognizant of that.
Yeah, so then outside of that, as we do wrap up here, what is the risk?
I mean, the risk is, as they start to, have earnings, there's going to be, some pullback. And as well as, with people selling shares, the insiders in these, first 3 to 6 months, there certainly could be some pullback, because, if their revenue reports, worse than what people are expecting in these first, 6 to 12 months, I think you're going to see some pullback as well of people not being as high in it as they were before, because there's such a frenzy right now of, a lot of people are buying, again, that what Elon said is the $1 trillion revenue by 2030. So that's what people are buying right now. But if the revenue goes in a different way, I think that's, one of the big risks that people should be looking out for.
All right, so be cautious, perhaps a bit frugal in the number of shares you buy up top if you're interested in doing so now, and just be mindful of what you're doing.
Yeah, absolutely.
All right, Derek Williams, always good to see you, good sir. And of course, this conversation will be at the ready for you on the WWL app throughout the day.